Hello, and welcome back to CFI Deeper Dive, a weekly show where CFI dives into the concepts behind the financial market events to help you stay ahead of the curve. One of the interesting themes from COVID-19 and the resulting shutdown was the housing market, and specifically what was happening in the US markets. Whether it was the stimulus that the government was providing, or whether workers found that they could essentially work from anywhere, or whether we had very accommodative interest rates and high inflation fears, home prices surged in the US. However, since the end of the pandemic, employers are starting to mandate employees go back to the office, mortgage rates have climbed, and the stimulus tap has been turned off, which has led many market watchers to worry about housing prices in the US. Recently, market watchers have turned their attention to how iBuyers have skewed that market even more and how this may result in increased risk to that market. For those of you who are not familiar with the term, iBuying and iBuyers are relatively new in the world of real estate, but they're making a huge impact on how people buy and sell homes. iBuying stands for instant buying and refers to the process of using technology to quickly and efficiently purchase homes without the need for a traditional real estate agent or intermediary. iBuyers are the companies that use iBuying technology to make these purchases. They're typically larger real estate companies. And behind those companies are large private equity backers and other institutional investors. So what do you know about iBuyers? Stay tuned as we take a deeper dive into the world of iBuying. Firstly, iBuying is great for sellers looking for a fast, convenient, and hassle-free way to sell their homes. They may be facing financial difficulties, may need to sell their home for personal reasons, or may just prefer the speed and efficiency of iBuying. With iBuying, you can receive an offer for your home within 24 hours and complete the sale in as little as a few days. In contrast, traditional home sales can take several months to complete, and homeowners must pay commission fees. Additionally, if you have an older home that may require repairs or renovations, iBuying may also be a good option, as iBuyers typically purchase homes as is. The process of iBuying is simple and straightforward. First, the seller provides some basic information about the property to the iBuyer. This information may include the address, square footage, number of bedrooms and bathrooms, as well as some recent sales prices of similar homes in the area. The iBuyer then uses algorithms and data analysis to determine the value of the home and make an instant offer to the seller. If the seller accepts the offer, the iBuyer arranges for the purchase, typically with cash, and deals with all of the paperwork and closing costs. Although iBuying seems like a great idea, the predatory nature of the business model may have contributed to rising house prices. iBuyers like Zillow, Redfin, and Opendoor distorted the market with their piles of cash and forced out buyers and smaller investors. Also, iBuyers purchasing and selling these homes in bulk have some control over setting the market price to make a spread. For example, if Zillow purchased a large amount of houses for $500,000 each and then purchased a few more for $550,000, they could easily just set the selling price for all the houses above $550,000. All this sounds like a great business model during an uptrend in housing prices, but as the housing market has fallen, the opposite also holds true. In addition to this risk for VC and PE backers, there's also the risk of further contagion to the capital markets. When an iBuyer purchases a home, it typically holds onto the property for a period of time before reselling it. During this period, the iBuyer can create securities backed by the real estate assets it holds, and then sell these securities to investors. The creation of securitized products results in new sources of funding for the iBuyer, which can then be used to purchase new homes. This creates a self-sustaining cycle where the iBuyer can use the funds generated from the sales of securities to purchase more homes, to create more securities, and so on. However, investors in these capital market instruments are exposed to the risk of declining housing prices, as the asset values backing their investment could deteriorate, as well as increased risk of defaults of the borrower. Existing home sales in the US, shown by the blue line, are down over 11% in 2022 from the peak. And while the Fed continues to hike, as shown by the white line, mortgage rates look set to continue going up. So clearly the risk has increased and the iBuyers are feeling the pain. We won't know if this may lead to larger issues like those that the US subprime housing crisis created in 2009, but remember that while capital markets may not always repeat the same past mistakes, they do often rhyme. If you're interested in learning more about the securitization process and its role in the world of finance, make sure to check out our course called Securitized Products Part 1. Thank you for listening, and we'll see you on the next CFI Deeper Dive.